All right, hello everybody. Welcome to another episode of Talking with Traders, where we get to know the people behind the trades. Today I've got a great guest with me, the great Tom Basso. Tom's a former hedge fund manager behind TrendStat Management. He's a chairman of Standpoint Funds. Correct me if I got that right.
Yeah,
Uh,
you did.
and a published author who's written books about trading and is currently working on a new book right now. Tom talks a lot about hedging. This is his fourth time being on one of our programs. Tom, it's great to have you on again.
It's great to be here.
Thank you. Yeah, it's always fun to talk to you. You've got a lot of wisdom to share. So let's jump right in. I usually start off with a question: how'd you get into trading?
The short answer, I suppose, is I got bored of chemical engineering.
Okay.
I decided I needed to have a way of backing up my chemical engineering salary. Back in those days in the 70s, if you can remember that far back, there was a lot of boom and busts, and engineers were sort of a commoditized employment. If you had a boom, there was a lot of engineers hired, and then there was a bust, and all the engineers would get laid off. So I figured I better put a portfolio together to back myself up and make it through some lean times if got laid off. And what ended up happening is had some successes. Ended up in an investment club where I was managing other people's monies. That grew into an investment advisory business. That grew into a commodity trading advisory business, which grew into a currency trading business. And then I retired when I was 51, and I had managed at the peak about 600 million for people all over the world, including some pretty major institutions. And it's just like one day follows another, and you start out with no particular plan, and then thing just keeps going, and you just kind of go with it.
Isn't it funny how life works out that way?
Yeah, yeah,
What
exactly.
I'm just curious as an engineer, what was the thing that clicked and said I should get into managing building a portfolio
I think the
versus other
thing,
ways to make additional income?
well, I think it's a lesson that my father taught me. Actually, my father was extremely conservative to the point of absurdity, and he decided that he would try to get rid of all the risk of owning real estate. So he just paid cash for his house. I can live with that. Secondly, he had other friends at the post office where he carried mail. He was a letter carrier. And he ended up kind of scoffing at some of his friends that would go into the stock market and stuff like that and watch the value of their portfolios go up or down. He didn't want any part of that. So he went down to the local savings and loan and bought some CDs.
Okay.
And if anybody is remembering what happened in the 60s and actually the 80s, with CDs at savings and loans, there was about a several $100 billion wipeout of the savings and loan industry because the yield curve inverted and the savings and loans were bankrupt. He was in the middle of that. So
Ouch.
his desire to be conservative failed miserably. And that led me to the belief that the concept I call attacking risk as opposed to trying to hide from it. If you can discover a risk and you know there's a risk, like the stock market going down, if you have a long portfolio, is a simple example. You know that most stocks are going to go down in a bear market. And when that happens, your portfolio's probably going to go down, give or take, you know, a few percent here and there. The S&P is down 20%, you might be down 23, you might be down 18, but you're going to probably be down. And if the stock market goes down 50%, you're probably going to be taking a hit somewhere along the way.
Oh yeah.
So if you know there's that kind of risk, why not set up an indicator like I do on TrendSpider actually with the hedges, where I can just throw on uh, a, a short futures contract or a short SPY position, buffer the other side, the long side of whatever's left that hasn't stopped out yet over in my stock portfolios, in my ETF portfolios, and you just basically sort of take yourself out of the market. So you're managing that risk as opposed to just trying to hide from it.
Okay.
And I like that concept better because it gives me a lot of peace of mind knowing that I took proactive action against that risk. And if I did my job right, hopefully I've mitigated a lot of that risk and I can rest easier at night. And that's kind of where I get to. I think a lot of traders either ignore the risk, which is dangerous because then it comes to visit you and you're not prepared, or you try to hide from it. And the concept of don't look at my monthly statements and buy high dividend stocks and just ignore the fact that the prices are going up and down and all over the place. And all of a sudden, you wake up to the point where your portfolio is down 30% and you thought you were in conservative, quote, stocks. And, that's not the answer. I think you gotta face up to the fact that there's risks everywhere. And heck, the way the country's being run today, you got to wonder if there isn't risk with T-bills. Uh, in terms of the deficits and the debt that's been
Yeah.
built up and the stuff that's going on. If Congress decided in their infinite wisdom to just default on the T-bills, there's no reason why they can't do that. It's theoretically possible. Never happened before. Probably unlikely, but if you think through all the scenarios and you really were, writing an interesting fiction novel, you could certainly write that into the story.
It's
So
not outside of the realm of possibility.
yeah, so
Unlikely.
you gotta go after it. Then you gotta look at it, like what is diversification, for instance. You look at well, my sister. I'll tell a story about my sister. My sister had said knows that I'm a money manager. So hey, Tom, could you look at this? And so I look at her portfolio, and she's got four growth stock mutual funds in there. And I said, well, I'll go back home to Scottsdale and I'll run some numbers and I'll give you a report over an email. And I run these things, and they're all gigante, multi-billion dollar growth stock mutual funds, all household names. And when I plotted them in the last 10 years, the last 5 years of those 10 years are literally like one line on the graph. They're all like literally painting each other in terms of the graph, which tells me when one goes down, the others are going down, and when one goes up, the others are going up, and there's no diversification whatsoever.
Yeah.
So, trying to really find true diversification in today's world has forced me to go far and wide into futures and to look at option spreads. And I'm currently trying to do some evaluations on how I can have a couple different cryptocurrency strategies, and I just keep evolving into more diversification. I start diversification by time zone. I have a 9-day things that I'm doing versus a 21-day and some other indicators that
So
gives me diversification by time.
are you trading in and out of positions often, or are you holding long-term holds and then hedging around them based on the market?
Uh, a typical day, I'm going to get some executions. Right now I'm running just slightly more than 50 positions in 8 different strategies in 3 different time periods.
Okay.
And when you got that much going on in your portfolio, the chances are you're going to get some executions every day. It might be selling out of an ETF. It might be. I think today I did 3-day trades because I happened to be sitting at the desk all day. Turns out I had a lot of computer work to do today. So as long as I'm here, I just try to pick up a few $1,000s over here on the screen next to me while I'm working. So it's kind of pretty easy for me to do. And but, I think I had 2 ETF trades, 3 day trades, round trips,
Okay.
and I probably had 2 futures transactions.
So
It's
you
not a
talk
lot.
It's not a lot, but it's a lot for a beginner.
Yeah,
Um,
probably. But considering the size of my portfolio and the fact that I got 50 something positions,
yeah.
it's not it's not like I'm glued to the screen all day.
So of those 50, how many, like how long do you typically hold for?
The the tongue in cheek answer is as long as I possibly can. Uh, let your profits run, cut your losses short. Uh, Reality, if it's a futures trade, there's a lot of times I'll hold it right through to the next roll. Like a lot of times, a crude oil trade to the long side lately, I've probably held on to the basic trade for I don't know 3 or 4 months, but I've rolled it 3 or 4 times. So I've
Got it.
when the time period comes up towards expiration, I have to roll it into the next contract out a month out. So that's going to mean that I'm still in that same crude oil trade, but I'm now in a new contract. So some software or some traders would say I just did 4 trades because they don't include the rolls. I like to, mentally think of it as one crude oil trade with some costs of transactions and executions along the way.
Makes
I've
sense.
been in a, I was in a quite a while ago, but a yen trade for about 15 months. That was probably one of my longer trades of my life. A lot of the ETF trades I do can have, some runs of 9, 12 months, something like that.
Got it.
Some go against me and get whipsawed, and I'm out 6 weeks,
Always
whatever.
fun.
Yeah.
So, question that I had for you, you talk a lot about hedging, right?
hmm
And this is a question that's come up before. How much, like, what what is a reasonable cost of hedging for you? Like, because if you lose 1% in hedging, you have to make 1% more in order to be profitable on the trade. How do you look at the costs of that insurance relative to the positions that you're holding?
Yeah, I'm in a different situation than a lot of young traders trying to make their first 1,000% return. I'm retired. I've comfortably got a good sized portfolio. I live off of it because Social Security does not pay for my lifestyle. And so what ends up happening is you sort of look at it when I'm hedged, I really have a position long and a position short. So it's sort of like I'm not in the market. And if there's a cost to doing that, that's okay with me because rather than having the risk sitting over top of me and losing sleep at night over the potential loss of capital, I rest easy when my hedges are on. So to me, it's sort of as long as the net result of the combination of hedging and the results from the underlying portfolio work out to be fairly positive, then uh, I'm not too obsessed about the cost. 1% is fine. If you do a couple of hedge trades a year, that's a couple percent. If instead of making 12, I made 10, I'm good with that. It's the difference between any one number and a couple percent less is not enough to worry about in my mind.
That's fair. I thought it was worth asking because a lot of traders, they like to say things like, I hate hedging, right?
Yeah,
Because it costs them money every time they do it.
they do.
I've seen some traders I have a lot of respect for say that every time they take a hedge on a position, they regret it later, right? So they
hmm
hedged early, or the price kept going up, so their hedge became worthless.
Yeah.
So it's always good to kind of get other perspectives on it because I do
hmm
agree with you, right? Like, it's all relative.
Yeah. If you take the ridiculous example of the 2020, the COVID year, I think ended up with hedging on some of the long positions. I ended up with like 103% return for the year, which is the best year of my life. And that wasn't because I was brilliant. It was just because COVID jammed the markets around so horrifically that there was a lot of opportunity, a lot of trends. I caught them. So it ended up paying for a lot of money. But the hedges that were on when the downswing happened ended up working out fine. They actually made money. Then I turned right around, and because I just took the hedges off, my portfolio on the long side just took right off and went to the upside with the up move after COVID started. So you end up with some things that happen in the markets that benefit you, and it's not like you're smart enough to figure that out ahead of time. It's just that that's what the markets did, and went along for the ride. So
It just happened, right?
yeah, exactly,
In pool, they call it slops, right? Where the ball goes in, you didn't mean for it to go in, but
exactly,
so
exactly.
um, so question: do you always hedge with futures or short equity, or do you ever use puts?
Uh, that's a good question. Puts are a possibility. The premiums in them get really expensive buying the put long. What I find most tax efficient and easiest to do is to use things like the ES futures or the NQ futures for NASDAQ or RTY for Russells if you got a smaller portfolio, a smaller cap stock portfolio. The tax advantages of futures versus stocks. Let's talk about that a second. Because way back when there was these things called tax straddles. That's probably before most of your listeners were born. But back when I was just starting out in trading, they used to do silver straddles a lot. That seemed to be popular because silver moved a lot. And the deal would be is you come into the end of the year and a trader would have amassed some profits and that's all going to be taxable. So what he would do is buy a December and maybe sell a January or the opposite, whichever way you want to do it. One side of that hedge, that straddle, would end up losing money and the other one would gain money. So he would close out the one side that's a loser that's offsetting his profits from the rest of his trading in December, making it a taxable consequence and offsetting his losses or offsetting his gains, I mean. That meant
Interesting.
that the other position he would close out on January 3rd and he'd be shoving all his profits from trading into the next year.
That's brilliant.
And that, well, it was brilliant while it lasted, but the IRS decided they weren't making as much money off of all the traders out there. So what they did is they settled for what's called I think it's 1256 if I remember the number right, 1256 mark to market contract. So all futures when you trade them are 60% long-term gains, 40% short-term gains, and everything is marked to the market at the end of the year. There's
Mm,
no longer anything like a tax straddle in commodities. So the fact that they have that rule on it makes hedging interesting because now if you get a nice hedge trade that ends up making a lot of money, it's 60% long term, 40% short term. It gets an advantage in tax treatment. And the other thing that's an advantage is wash sales. When you end up with doing ETFs and doing some things, if you're buying and selling and doing it on any shorter term time frame, you got to be sensitive to is it 45 days or something, whatever the
30, I
number is,
think.
30. It's moved around, I think, a little bit over the years, but you don't have any wash sell rules because you could trade every day in futures and it would still be the same 60/40. So it simplified the tax structure and made it easier to just throw stuff on, take it off, not have to worry too much about it. And that's why I like it. There's very good liquidity. I mean, the S&P futures, for instance, is massively traded. You have no trouble getting in and out with any size of dollars you want. And I even found SPYs interesting. I used to short SPYs when I first
Super
started doing
liquid.
hedging, and that's the Standard& and Poor's 500 Spider, obviously. And it's I think, the largest traded instrument on the exchanges these days, isn't it? Like a couple 100 million shares a day,
If
I
it's
think.
not number one, it's a very close number
Yes,
two. Like it's
exactly.
big.
And despite that, would you believe I was at a brokerage firm during, I forget whether it was COVID. I think it was farther back than that. It was a meltdown situation. And I was trying to do a hedge for my wife's portfolio, and she had a different brokerage firm than I did. And believe it or not, they wouldn't lend me the SPYs. They said it's not available. I could not believe that. I mean, it's the most widely
Surprising.
traded thing in the world, and they can't lend it to me or go find it someplace. I thought it was astonishing. So that's another advantage because futures, if you initiate a contract and you want to go short, you can go short. It'll just happen. If there's another buyer on the other side, there's no borrowing going on, there's no lending, there's no interest rate charged. It just simplifies the process. So I find it
Okay.
easy. Now, puts, the problem I got there is you have the time period, which you also have in futures. So that's not any different, supposedly. But the fact that you have an option means that you have all of the premiums, the time premiums, the volatility premiums, and it
Agreed.
gets to be a little obtuse at times as to whether you're paying an awful lot for that insurance. You know, the premium gets so much that the market really has to go down quite a bit for you to really come out ahead on the deal and to offset uh, the danger to your underlying portfolio. So I find options more time consuming, a little more manual. You have to be hands on more. there's advantages there too. I mean, you could with a put, you could put up a small amount of money, and hopefully, if you had a major hit, make a ton of money off of a put option, let's say, and it would offset a tremendous amount of your losses for very little money. But then the other side of it is when you have an incorrect hedge or a whipsaw, you're probably just going to lose that entire put. And it's a fixed price. It's like insurance. You don't get your insurance back if you didn't get a fire that year. You still have to pay your fire insurance. So it's kind of the same thing. But sometimes the premiums get a little bit hard to swallow, I think. And futures, it's more, I don't know, it's just you're trading with the market one for one, and there isn't this ton of premium you got to worry about too much.
Yeah. I mean, I always struggle with options for that very reason.
Yeah,
You could be right, and you could still not make money because
exactly.
it was too expensive at the onset, right? Too much
Right.
premium.
And it's really hard to determine, for me at
Yeah,
least. Option expert might find it simple. But for me, I have a hard time deciding whether or not I'm getting an appropriate deal or not and making that decision.
it's
So
tough.
I
A
stay
lot
away.
a lot of traders like to say things like, when the market's going against me, I go to
Hmm.
cash, right? I
Hmm.
just I just close out all positions. Do you ever do that, or do you always
Yeah.
stay in the market?
No, in the case of my ETF sector funds, I was down to just recently about 25%. Was it 20? 25, I guess. No, 20, I even got down to 20% invested. So out of 20 different sectors, I was down to four positions right at the depth of this recent downswing. I'm now back to, I believe, let's see, what did I count this morning? I just went over 50%. I think I'm 55% invested now. So
Got
the
it.
sectors are starting to click in. The hedge came off about 2, 3 days. I guess it came off last Friday, and now the longs are starting to come in. So I time on some strategies. I still have exposure with the timing, so I'll hedge the exposure. So I sometimes have multiple ways of trying to manage risk, but in all cases, in my mind, even timing is a way of attacking risk. If you know there's
What do you mean?
stock market risk, you time yourself out of the risk back into cash. You've taken a proactive, aggressive attack on risk
Okay.
to time it. So I view that as a viable attacking of risk. I think options are a viable attacking of risk. I think futures hedging would be. I think to me, diversifying in so many different ways that like I think I'm trading 28 or 29 futures markets these days all around the world, and plus the lots of different ETFs which broaden my exposure there, so I'm not hit by a single company having a bad day. It spreads it a little bit more into sectors so that I can pick and choose there and spread my risk there. Different
Got it.
time periods. By diversifying that much, you're attacking individual instrument risk that always can go against you and spreading that out. And it makes your equity curve look a lot smoother.
Do you ever play with leverage ETFs? Like, for SPY, there's a SPXL, which is a 3x
Mhm.
leverage version of the same thing.
I do that with my wife's IRA
Okay.
because you can't short an ETF, and she's at a brokerage firm that does not have any futures. And an IRA and futures they're really going to nick you for large amounts of margin. Even at a place like Interactive Brokers or something, you're going to probably do three times the normal margin to cover your future position.
Okay.
They will let you do it, but it's a little more difficult. So at my wife's IRA, which I also manage, the easy solution is an inverse leveraged long position in an ETF. So I use SPXU, but same
Okay.
kind of thing. Triple leveraged, upside down, inverse fund.
Those things can really move.
Yeah, they can.
I've
And
struggled with them. I've been experimenting with building automated bots. So I had one that traded a list of like five major leverage ETFs, and you know just broke even. Yeah, I was actually shocked it didn't go negative, but it would make some money and then it would lose it all, and it would make some and it
yeah,
would lose it all. I'd get whips out all the time.
yeah.
They're tough to trade.
Yeah, they do have that little wrinkle to them, the conversion back to each day
Yep,
to the positions, and it kind of messes with your returns. But I'm looking only to try to mitigate a 50% down type of situation. So if the hedge doesn't work out precisely exactly what I'd like, it's usually not the end of the world. So.
got it. What are some simple strategies or approaches to hedging that newer traders can kind of experiment with? Right, like what would you tell somebody who's like, I'm holding a large position in something and I'm worried about it?
Well, the one I see the most would be the person who's getting towards the end of their working career and they've ended up with company stock and they have a large position in it. And I usually get the question of what should I do with it if I exercise my options and take all this profits and put it into a diversified portfolio? I'm going to have to pay taxes on all these gains. And, uh, and yet, if the stock market were to get hit, uh, I've got a lot of exposure. So let me coin an example. Let's say you had, I don't know, you were selling pharmaceuticals or something all your life, and you end up with a bunch of XYZ pharmaceutical company stock long, and you want to say diversify it over a long run, but you'd like to sell that off little by little. An easy way to think about approaching that would be number one, you got market risk. So stock market risk, you could use something like hedge, use a SPY short sale or open up a futures account and do an ES futures against it when you see the market goes to a down signal. So use whatever your favorite buy sell engine would be and whatever your favorite platform would be. In most cases, you could probably use your own broker platforms. You'll have simple things like Donchian channels and Keltner bands and Bollinger bands and other different types of moving averages, whatever your favorite is. When you get a sell signal, go ahead and put on that hedge and then just leave your pharmaceutical stock there. What you're doing is taking away a lot of the market risk. If you want to be more specific, then you could drill down into things like either a pharmaceutically oriented sector fund, ETF, or you could use a healthcare type of ETF. Most of those are going to like have high correlation to each other, but they're
Hmm.
not a precise hedge. So the IRS figures, okay, well you've got this ETF over here that's got a whole bunch of different stocks in it, and your stock over here is an individual issue. So those don't match each other. It's not a taxable hedge. It's a two different things that are somewhat correlated but not precisely. So I think the rules would be, I mean, you could check with your own tax advisor, but I don't see that that wouldn't be allowed as a reasonable way to mitigate some risk without absolutely selling the stock out and then having a taxable consequence.
Yeah,
So that's kind of the probably the most common question that I've run into over the years. People starting out there. If it's just a new trader, he's in his 20s, starting out in life, maybe he bought a few stocks, and he doesn't want to sell those out. Probably the easiest, probably futures is a little overkill for that because you aren't going to get the small enough size contracts to be able to deal with it. You probably look at just trying to short some kind of an index like SPY or an equivalent and throw a little bit of your margin money. So if you've got 100% cash, say $5,000 account, and you got $5,000 of potential margin, use some of that extra margin to go short uh, an ETF of some sort that's broadly diversified. Could be a Russell, could be a SPY, uh, those types of things. That's probably the easiest approach.
makes sense. I know that you're and you've been on our programs before talking about back testing as a way to kind of identify those
Yeah.
signals. um, and I know that there's a million different ways to back test
Hmm.
in order to find like a reversal signal, but it's kind of the holy grail in trading is to figure out when it's time for something to kind of pull back or keep going. What's your favorite strategy that you think a beginner would be able to kind of pick up on?
Well,
um,
if you go to enjoytheride.world
okay,
backslash hedging,
we'll put a
or is
link in
it?
the description.
Yeah. You go to the website anyway and look for the hedging tab, and I have an explanation of what actually use for my indicators. And I like three different indicators because they measure different things, and I'll take the first of whichever one's hit.
Okay.
So really what it takes for me is there's three different indicators, but I use six different indicators and things like TrendSpider and other platforms because what I've got is a to the stock market over a long period of time has shown a bias to the upside. So I'd rather make my indicators biased to be more easy to get in and harder to get out. So I use a 21-day combination of Keltner, Bollinger, and Donchian,
Okay.
and whatever one's hit first to get into a uh, a long. And I use a 50-day Keltner, Bollinger, Donchian to get out of an ETF. And I do
Okay.
exactly the same thing with the hedges. So it makes it harder to put a hedge on, but when I put a hedge on, it's pretty serious. I mean, deterioration has happened. It's starting to be look, I'm starting to feel it in the long side and stuff's stopping out and I'm getting to cash, but I still have exposure. That's when if the S is going to hit the fan, um, the 50 days is going to go over you've got a little bear market going on. At minimum, you probably got an automatic or official correction going on. And so that's kind of the way I look at it. I'm very quick to get back in. This most recent upswing in the stock market the last couple days has gotten me in from about 20% invested in my sectors all the way up to about 55 now or something. So they're starting to click over. I'm getting signals while I'm sitting here uh, doing other work, and it'll say, "Okay, I just bought some kind of a spider of some sort, some kind of a sector fund." And it'll tell me the number of shares and the price, and I'm back to work. Uh, so that I think the 21-day makes it more sensitive to getting back in, and so I was very quick to capture a lot of the good gains back in 2020 because a lot of my Keltner bands and Bollinger bands were very getting wide because there was a lot of standard deviation. The Keltners came into play because they use exponentials in my cases to get that math to get it down there near the market. So it didn't take a huge amount of time for it to all of a sudden come back and start kicking me back into a lot of positions. And so I rode the whole upswing, and that was obviously lucrative. So
Clever.
that's kind of the way I look at it. Donchian channels work great in tight markets where there's a lot of sideways action, and you can get those tops and bottoms that the Donchians are good to do. Where a lot of if it's volatile and just going sideways, sometimes the Bollingers and the Keltners will be wider, and the Donchian will be the tight indicator, and that'll be the one that triggers the buy or sell. In crashes, it's usually the Keltner that'll get down to where the market is faster. The Donchians will be still up at the previous high, and you're far, far away from ever getting back in.
Yeah.
So that's why I like the combinations. Their mathematical personalities are different, and they kind of strengthen each other. If that makes any sense.
It does.
Uh, it, diver-
How did you settle on those three?
I wanted a couple different aspects. I wanted each of them to have an aspect of market volatility. Donchins would have it by way of the extreme points of the high and low. So that's a form of volatility. Bollingers, of course, are standard deviation driven. So it's a moving average of some sort. I use exponentials always. I never use simple moving averages. Exponential for the middle, and then a certain amount above, certain amount of below based on standard deviation. And then the Keltners use average true range, a measure of volatility, top and bottom over top of the moving average. So they're each three is measuring something different, but they all include volatility. So they're all going to take their turns jumping in to be the one, that's first up to go over. They all are they all have another aspect that I like is what I call a noise band.
Okay.
You got the top band and a low band, and in between is noise, and I don't want to do anything. Noise is to be ignored. That's normal market movement that I can ignore. I don't take action. So if you look at then breaking upward through the top line as the buy and breaking downward through the low line, the bottom line as the sell, it's mindlessly simple almost to realize that I'm in an uptrend or I'm in a downtrend. I'm long or I'm a short. I'm hedged or not. It's yes or no. It's simple. It takes you seconds to figure out what you're supposed to be doing. And there's none of this angst of trying to interpret chart patterns or, the complicated, trying to figure out where the cycle's going to go or where's the Fibonacci retracement or all these other things that to me just give the trader a lot of information that may or may not be useful at any point in time, but he's trying to figure that out. This is simple. It's either yes or no, up, down. You ignore the noise, and it makes my trading life a lot easier, and I can go out and play golf.
Makes sense. Do you? I'm just curious.
Mhm.
What is that? What would you say your most memorable losing trade is? Like, which one stung the worst?
Well, the sting of all time, I think, was well documented in New Market Wizards in my chapter.
Okay.
And that was the silver trade that I got into successfully with multiple contracts. And my account was something like, I want to say it was like 130,000 at the time. It was trading futures. I'd stuck to all my trades that year. I was highly profitable. I was moving along nice. And along comes a long silver trade. And the Hunts decide to try to corner silver. And I'm on the same side as them. So my account's going up and down, tens of thousands a day, and all of a sudden my portfolio hits about a half $1,000,000,
Wow.
starting with 130, and this is in a very short period of time. That will catch your attention for sure, especially as a young engineer in his 20s, or might have been early 30s, something like that. So I'm watching it, and darn it, I am going to really stick with this thing. I'm a good trend follower. Let your gains run, cut your losses short. I got my stop in. Uh, Limit moves are all going my way. No big deal. Well, all of a sudden, was it the NYMEX? I think that there was changed the margin and said, okay, we're going to go to full margin now. Well, the hunts were leveraged. They couldn't handle they didn't have enough money to come up with all that to pay for all their contracts, so they had to sell contracts. And now we're limit down every day. And things are going against me. And the 500,000 is now 450, and it's 425, and it's 390, and by the
Ooh.
time I get out, it's 250. To which the astute mathematician in the audience would say, "Well, that's not bad. You ended up at 250. You started with 130. That's a very nice return for one trade and a few months of work." But to me, I'm remembering that half a million and losing half of the money. And so that was probably, out of all the trades I've ever done in my life, one of the most impactful because I really soul searched on that one and I really developed my volatility control schemes that I outlined in my book, Successful Traders Size Their Positions, Why and How. I give everybody, the reader, the math that I now use to measure volatility and to size my positions appropriately so that on an ongoing basis, why did I have to hold the original number of contracts in silver that I started with? The market had changed and become more volatile. So why didn't I just reduce my position size into the excitement and maintain the same amount of volatility exposure to my portfolio to silver as I had when I started out, sort of? If it was okay when I started out with this much volatility, but then the volatility has, grown to 10 times that amount, maybe I should have 1/10 the position, or maybe 1/6 of the position, or 1/5 or something,
Or a hedge.
or a hedge or something.
Yeah.
It just seems like I was holding on for dear life and stressed out over it. and there was no need to do that. It was not like if you have 10 contracts and you sell off 9 of them, you still have 1 contract left. You're still letting your profits run, cutting your losses short, you're being a good trend follower, but you're also being a good position manager, which I think a lot of new traders forget about. I think maybe because they always either trade 100 shares of something or they only trade 1 contract in futures or 1 option, they don't have a lot of size of their portfolio, then there's not a whole lot of choice. You're either in it or you aren't because you got 1 contract. Either you sell it and you got 0.
Yeah.
But
Or
if
they
you
end up in really in penny stocks, right? Or
Yeah, yeah,
far dated leaps, things like that that you
yeah,
don't fully get.
yeah, exactly. So in futures now, I think the exchanges have finally figured out, and I commend them for it, and I advertise it whenever I can. These micro contracts are a godsend. I am using them myself in about, I don't know, out of 28 positions or whatever I've got in different futures markets. I bet you I've got probably 10 or 12 different micro contract positions.
Yeah.
Because why do I have that? Well, if I go in and I do 30 of something and then the market goes nuts, well, I can sell off 5 of them and now I'm down to 25. And I still got the position, but I got the same amount of volatility to my portfolio and I'm controlling it so I don't let that one position dominate my portfolio. And that allows those 28 things to operate a little bit more like the pistons of an engine. If you ever cut away a car engine and one piston is going at the top of the cylinder and the other one's down at the bottom, getting a gas burst and explosion in there. And you look at all these different pistons going up and down. They're all going up and down at different times, but the car is going forward. That's I want my equity to be going up the chart, and I know that not all these markets are going to do what they need to do at the same time, and that smooths things out and it just keeps the car going. And I think that that's the way I look at it. And the micro contracts allow you to fine tune it even more. There's a time when it gets ridiculous. I mean, if you're trading 100 micro contracts, well, chances are you should be over in the large contract world, and it's
Yeah.
more efficient on your commissions and there's more liquidity. But I'm finding the micros trade really well. There's lots of arbitrage, that is, between the big contracts and the small contracts, so that my fills are halfway reasonable. I mean, I don't ever find that the fills are so obsessively obscene that I think somebody took advantage of the situation. And because as soon as it gets a little out of whack, somebody comes in and just buys that and sells 10 of those and
Yep.
pockets the change in between, the pennies here and there, and just do it whenever they feel like it, and that's their job. So I think the contracts are good. I think the options again are a difficult game, so you got a lot of stuff to figure there. But I that's what probably stung me the most is that silver trade. I'll never forget that one and what it did to my day. There's been other losses, but the loss on oil was another one, I suppose, that comes to mind. That's also well documented. I was fixing a computer program one night at Trendstat, and we hadn't got our orders in yet, and I was getting really nervous about that. We're managing hundreds of millions of dollars, and the program, for some reason, is not working. So I got one of my computer guys there, and he and I are fighting it, trying to figure it out. And then it's about 5 o'clock. I'm getting hungry. I said, "Hey, Dave, I'm going to go over and buy some Chinese across the street and bring back. I'm going to take a break for dinner and then we'll go back and attack it again." So we did. And we had a good time talking for about half an hour, got our minds off the problems, came back, and would you believe, found it right away. I said, "Okay, so you go ahead and finish the program then. Let's run a test and then we'll send the orders and we'll get out of here." So he did. Meanwhile, I'm kind of curious what's happening with the overnight markets. And I knew we were long crude oil at $32 a barrel that night. And this was the first Bush president invasion of Iraq from Kuwait. And it's running about 8 o'clock at night, Scottsdale time. And crude oil is now at $40 a barrel. Now, $8 a barrel in the last few days with Ukraine going on and all the nonsense that's gone on there. Crude oil's moving up and down that much nowadays, but back in those days at 32 to go to 40, that's a huge
Big move.
move. So I go to sleep that night thinking, huh, we're long crude oil and it just went up $8 a barrel. This is going to be very interesting coming to work tomorrow and seeing what happened. And it was more interesting than I knew because it was at 22 when I walked in the
Wow.
door. and we stopped out, and the risk on that trade to go short and reverse was so large, I couldn't do even one contract for people unless they had like a 4 or $5 million account, and there weren't a lot of those. So a lot of people just got iced out of the downside of crude oil, and then it found its level and started climbing back, and we were at new highs on our equity curve in about 2 months. So that was one of our worst days. Being a diversified trader, we were down 6% in one day, which was huge for us. That was devastating.
So
Um,
how do you deal with that kind of day? This is something that a lot of new traders struggle with, right? Like, how do you psychologically,
yeah,
keep it together when you see so much red for an entire day?
yeah.
This is where people throw in the towel and just give up.
Well, I got several tricks for
Okay.
you. The first trick is always think in terms of percentage, not in dollars. Because when you're trading $600 million of other people's monies, and you pull up the screen and it shows that today we're ahead $10 million on our client assets, or we're down, uh, 4 million, $5 million, you have to kind of realize that that's, a half a percent, or 0.4% or 0.3% or 0.8% if a big up move. And that sort of calms you down a little bit. The second trick I have that I still use today all the time is when you're making new highs, rather than be full of yourself and excited and be thinking about going out and buying a steak dinner and celebrating, remember the drawdowns. Remember how you felt in the pits of the drawdown and how depressing it was and how difficult, sticking to your knitting and continuing to do that next trade and be optimistic. And likewise, the other way, when you're in the pits of a drawdown and you're really feeling down on yourself and you feel like it's affecting your self-esteem and all that, remember those days when you're hitting new highs. And I by doing that, what you're doing is sort of what I call balancing your mental state. You're you're taking an exciting mental state that could be greedy, could take profits too quick, it could get too excited, or you're taking a depressive state where you're sad or you're frustrated or you're negative, and you're bringing it back to sort of, I don't care. This is just another day at the funny farm. I'm trading today, just like I did yesterday, just like I'll do tomorrow.
Yeah.
You're sort of trying to get your mental state balanced out. And if it's in a negative or a positive state, both of which could be sort of not real helpful to trading, better to just bring it back to balanced and say, I have no idea when I start the day whether I'm going to be making money or not, but I know that on balance, I have more positive days than I have negative days. I know I'll have some negative days. Cut the losses short, let the gains run, concentrate on the process, get get involved in the process, not in the results. A good day in trading should be that you ran your process flawlessly,
Yes,
not whether you made money or not.
I agree.
You don't get an A plus for making money, especially if you made a trading error that day and you didn't follow your strategy and then you made money. That's as far as I'm concerned, you just got a D
Yep.
for a
One
scorecard
one thing I
because you
do to that end, because I think that's probably some of the best advice that we've had on this program, right? One thing I like to do that I think is along those lines is I take my P&L off my screen during the day,
there you
right?
go.
Like, I'll look at the list of holdings, but
Hmm.
I try not to look at the actual whether it's green or red for today, right? I look at the chart and try to decide. It's like every time you look at it, it's like, do I want to buy? Would I buy this now? Right?
Sure. Hmm.
And you just stick to the process, and the profits will follow.
There you go.
So, um,
Concentrate on the process and let the results take care of themselves. I've said that many times.
1000% good advice. Um, so, besides that, is there any advice that you would give somebody who's brand new, who just started, who wants to make this into a career? What would you tell them?
Well, I I would tell them that life has changed a lot in the trading industry from when I started out, so don't copy me.
Okay.
Because I had the, I guess, good fortune to start out, as I said a long time ago. It was sort of, I it, I sort of got pushed into it, and one thing led to another, and all of a sudden I'm trading money, and all of a sudden I'm quitting engineering, and I'm going full time, and then I'm adding futures, and I'm adding currencies, and it's one thing led to another. I think in today's world, the problem you have as a new trader thinking of getting in the money management side of the industry, I believe, is that you can't just be a single person anymore. You'd have to find a team of other guys, guys or girls. I mean, I think people that have expertise in different areas back each other up so that you look like you have an organization, you have the proper amount of capital, you have the proper amount of backup systems, you have the computers you need. Everything has to be in place for anybody to take you seriously. And on top of that, with zero track record, you now have to attract money. You have to go out, talk to people over and over again. Marketing is expensive, it is time consuming, and it's sort of relentless. It's just you got to do it 100% of the time. And what ends up happening is it's just so difficult to get anybody to listen to you when you're managing $5 million and you've got 6 months of track record. No serious investor is going to take you seriously. So you really have to figure out that initial get it up to profitability level. And I think it's harder and harder to do that in today's world. So the big guys in the industry that are well established have big advantages over the newcomer.
Sure.
What I think is a better model for new traders that have jobs, are starting to save some money, and they want to get into trading. And I've told this to a lot of people lately, and I think it's the right model is to sort of try to do what I do. Try to come up with a way by tailoring your trading strategy to your situation. So, say, example, you work all day as an engineer. We'll use me as an example. I get done with my engineering job. I go home. I let's say I saved 25,000 or something, and I put the money into an account, and I run my strategies. I get a hold of a different platform of whatever my broker platform or a TrendSpider or something, whatever you can find. And whatever you need to do what you got to do. Then you go through your process, you manage your portfolio, and you're done. And you go on to dinner, your life with your family, whatever you got to do. And what you're trying to do is to build up your expertise and the size of your account. So you keep getting promoted over here on the earning the the business side or the worker side, whatever you are for during your daytime, and you're chucking money over into your portfolio as fast as you can, and you're still managing it and diversifying it and making it better. And your skill level in trading is coming up, and your amount of money that you're able to put in there comes up, and at some point, your trading portfolio starts getting more and more leveraged in terms of the amount of money it can make for the amount of time you're putting into it relative to your earning a salary. And when you reach that level where you feel comfortable, then you get rid of the job and you go full time.
Step
But
into it and develop your skills, right?
yeah, and the advantage is strangely, I don't know, maybe not strangely, the government in the US has gotten so pervasive on trying to regulate the futures industry, trying to regulate the stock industry, the mutual fund industry. There's a lot of barriers to entry on some things. There's platforms like I was just fooling around with looking at various exchanges and cryptocurrencies just the last couple days, just reading things and looking at things. And you got stuff like Binance has one platform for ex-USA, and then they have to limit themselves inside the USA to a lesser platform.
Yeah.
That's usually comes back to the US government trying to protect everybody, but in the effort to try to protect people, they prevent some things that may be good for you to have access to. unless you're offshore, and which then really, really complicates life if a U.S. citizen tries to do that.
Yeah.
So, and maybe even including breaking laws to do it.
Well,
So
they're not trying to
you end up,
protect you, they're trying to protect their tax income.
yeah, exactly. So what's happened to the money management industry? I see so many rules that ended up in unintended consequences, preventing new traders from coming up into the money management industry and doing the types of things I was able to do in an early age with very small amounts of money. It's harder and harder to do that today. You almost have to start out with a mutual fund standpoint. The story on Standpoint, I'm the chairman of Standpoint Funds now, and we had to raise a few $1 million right out of the gate. Day one, the mutual fund prospectus, would you believe some of these lawyers were $500 an hour. It was a
Yeah.
$500,000 legal bill just to get off the ground with $0. That's gone. That's
Yeah.
making you no money at all. Now you got to start raising assets with zero track record and you're 500 million or 500,000 in the hole. And the rest of the money we raised was just for working capital to pay 5 salaries that we had to have on place, so that we had a team that could do the whole thing. Now it's turned out we're over a quarter of a million now. We're very profitable. The team is still in place. Everything's cool. We're highly ranked in our segment of the mutual fund world. But so much faith had to go into that, and so much organization and structure and backups and computers and lawyers, and it's it's not an easy deal. It's not as simple as oh, I think I'll quit engineering and go into the money management business next year.
Yeah.
Uh,
That's why
it's
they
not
call
so.
them blood-sucking lawyers, right?
They were,
Yeah.
man. These guys were really expensive. I could not believe it myself, and
I
hell,
believe
I
it. I've seen
28
it.
years in the money management business. I don't miss it. I smile a lot more these days after I've retired from the money management business. It was good for me. I learned a lot. I had my challenges. I certainly did well for myself financially, but um, yeah, I have a mixed feeling towards recommending that a young kid would get involved in it these days because of what sort of it's become.
It's a different market. I mean, I've been in the markets for about 13 years, right? So nowhere
Yeah,
near as long as you have. And in
sure.
that time, it has changed into something very not recognizable, right?
Oh,
Like I feel like I'm trading a completely different market with a different personality, right?
oh
I
gosh,
think
yes.
payment for order flow (PFOF) has really changed it, right? Like the
Hmm.
underlying dynamics of it.
Hmm.
It's put some perverse incentives in place for brokers, right, for market makers, where they
Yeah,
can, essentially front run our retail trades and
yeah.
make risk-free income that way. And it's crazy that it's allowed, but it is the world we live in, right?
Yeah, and there's just all sorts of the volatility numbers, the
Crazy.
amount of markets. Just the other day, I was, the war had been going on for I don't know a week or two, so it was still pretty up in the air. It hadn't settled into the kind of the current steady state. It almost seems, and I think I counted, was it 4 or 5 limit moves out of 28 markets I trade. Limit move in futures means it's circuit breakers,
Yeah, it's five
basically,
percent,
cut,
right?
checking. And I was thinking, wow, lumber's at limit move, and unleaded gas has gone crazy. Crude oil's gone nuts. Bonds are down like three full big numbers. I was just astonished. I was looking at like coffee was 500 ticks. I, I've never seen in my 28 years of trading professionally and another 18 retired. I haven't seen anything close to that.
Yeah. No,
And
it's very weird.
so, needless to say, my volatility controls, my portfolio risk controls outlined in the book that I wrote, have been kicking in a lot lately. And I've been peeling off positions as fast as I can and trying to hold on to whatever I've got left and manage the risk and manage the volatility in the portfolio. So it keeps me busy, but it's been very profitable. Can say that. I mean, when you get disruptions in markets and a lot of big trends and you're a trend follower, it's a good time. But
Yeah.
Just craziness. The stuff I've seen just is more bizarre than I've ever seen in my life.
It's
So
it's the one word that I have for the market over the last since really COVID is humbling, right? Like it humbles everybody. You can come in here with a chip on your shoulder, right? All excited, and the market's gonna knock you around a little bit until you realize that you're just a trader and you just need to chill.
I have a sign that is literally 1 foot from my eyes. Let me read it for you.
Okay.
Unless you are humble in the face of the market will see to it that you are humbled.
Yes. Amen to that. That's true.
That's right next to where I sit every day.
Yeah, I keep the British war propaganda. Keep calm and carry on.
Yeah, that's a good one too.
So well, Tom, thank you so much. We're out of time here, so I have to cut it off.
Yeah.
For those watching, we're going to put all the links that you need to find Tom, his books, his website, his social profiles in the description. Any last words, Tom?
No, just keep calm and carry on.
Good
it's
deal.
the volatility will end sooner or later, and we'll go back to boring for a while. But so far, it hasn't happened. And just concentrate on the process. Let the results take care of themselves,
Absolutely. Thank you
and
again for being on.
enjoy the ride. ETR, enjoy the ride.
That's good advice that I don't think a lot of people take. It is a journey, and if you slow down to just observe it, you learn a little
Yeah,
bit more from it.
yeah,
So,
exactly. Dan, it's fun. Yeah, it was good.
well, thanks again, Tom.